You just won the absolute biggest construction contract of your career. It should be a cause for celebration. But for many contractors, signing that massive deal is the exact moment their business starts to die. The data shows that 80% of construction firms fail within their first 2 decades of operation. They don't fail because they forgot how to build. They fail because they win massive bids without having the liquid cash on hand to actually start the work. The industry calls this the mobilization gap. It is a strict 60 to 90-day cash flow void between the day you start moving dirt and the day you receive your first progress payment. So you're staring at a freshly signed $500,000 contract, but you suddenly realize you don't have the $80,000 to $150,000 required to get your crew and equipment on site. Navigating these cash flow traps is exactly what we cover on this channel, so take a second to like and subscribe if you want to keep your firm in the black. Until the exact cash needed to execute the job is sitting in your bank account, a signed contract is technically a liability, not an asset. This graph shows exactly how the mobilization gap drains your accounts on a standard $500,000 project. Notice how at day 0, your cash flow goes instantly negative. First, the project owner requires a surety bond. At a typical 1 to 3% premium, that immediately pulls up to $15,000 from your vital cash reserves. Next comes the physical mobilization. You have to transport yellow iron, buy fuel, and pay your initial crew. That forces you to spend between $60,000 and $130,000 out of pocket before a single shovel hits the dirt. Then the general contractor's progress payment schedule locks you out. You have to float those heavy operational costs for 2 to 3 months before the first check arrives. Even when that check does arrive, you fall into the retainage trap. The project owner holds back 5 to 10% of the total payment to ensure completion, which effectively locks up your profit margin for the next 12 to 18 months. These specific, compounding financial pressures are directly driving an 88.2% year-over-year increase in project abandonment. Contractors are losing their businesses over a fatal mismatch between their daily operational expenses and the industry's delayed payment schedules. This table compares the 2 primary ways to bridge the gap. The logical first step is a traditional commercial bank, but the immediate problem is the underwriting timeline. Banks take 4 to 8 weeks to process a loan. If your crew needs to be on site Monday, waiting 2 months means losing the contract. Furthermore, traditional banks require pristine credit and tax returns. They strictly evaluate your past history. This ignores the reality of your current situation. The bank gives 0 weight to the massive future revenue of the contract you just signed. Traditional commercial banks are not built to accommodate the rapid scheduling demands of the construction industry. Securing a low-interest bank rate becomes completely irrelevant if the approval delay causes you to abandon the project. This brings us to the alternative lending market, which processes applications and deploys mobilization funds in just 24 to 72 hours. Instead of strictly evaluating past tax returns, they underwrite the future revenue potential of your new contract. But this speed comes with a strict trade-off. You will pay a higher cost of capital for the extreme speed required to save your project. You have to treat this decision as pure math. You are weighing the cost of the capital against the catastrophic cost of inaction. These specialized alternative lenders understand the mobilization gap because they evaluate and fund it thousands of times a year. Sacrificing a percentage of your project margin to an alternative lender is the strategic, necessary cost of ensuring your company survives to bid another day. To actually access this non-traditional capital, you need to follow a precise 4-step pre-qualification protocol. Step 1 is proving a minimum of $20,000 per month in average bank deposits to demonstrate operational stability. This means you need to maintain a consistent, steady cash flow from a pipeline of smaller jobs in order to qualify for large bridge capital. Step 2 is calculating the exact dollar amount of bridge capital you need for mobilization, rather than just guessing a number. By requesting a precise figure between $50,000 and $5 million, you prevent overborrowing and keep your future debt payments manageable. Step 3 requires gathering 8 strictly required administrative documents before you ever apply. Strict upfront administrative discipline is what transforms a severe cash flow crisis into a solvable, routine transaction. The operational payoff of completing Step 3 is that submitting a perfectly organized file allows lenders to process your request in 24 to 48 hours. Disorganized contractors spend weeks trapped in underwriting purgatory, while organized contractors get their money and start the job on time. Step 4 is navigating to BusinessLoan.Directory to formally begin your pre-qualification process. Doing this grants you immediate access to a marketplace of over 75 specialized construction lenders. Expending the administrative effort today is what actually secures the physical capital you need to mobilize your equipment by Monday morning. In the modern construction landscape, architecting your capital stack is just as vital as winning the bid.